Today we are going to discuss about expected credit loss. We will prepare journal entries for provision for expected credit loss, and also determine the amount of expected credit loss under IFRS 9. But before we proceed further, please do not forget to like the video and hit the notification bell for future updates. So let's get started with today's topic. Expected credit losses arise when there is a possibility that a borrower may not pay back the loan or debt in full. IFRS 9 requires that financial assets be assessed for any expected credit losses at each reporting date. This means that at every reporting date, we need to estimate the amount of money we expect to lose if our customers fail to pay us back. In order to calculate the expected credit loss, we need to consider the probability of default and the loss given default. Probability of default refers to the likelihood that a borrower will fail to make payments as they become due. It is usually expressed as a percentage. For example, if we believe that there is a 10% chance that our customer will default on their loan, we would express this as a 10% probability of default. On the other hand, loss given default refers to the amount of money we expect to lose if a borrower does default on their loan. In other words, it is the amount of money we expect to lose if a customer does not pay us back. IFRS 9 requires that we use the lifetime expected loss approach. Under this approach, we estimate the expected credit losses over the entire life of the financial asset, regardless of when the losses are expected to occur. This is different from the incurred approach used under IAS 36, which only considers expected losses that have been incurred up to the reporting date. The lifetime approach is considered to be more appropriate, because it provides a more accurate and complete assessment of the credit risk associated with financial assets. Now let's see how to calculate expected credit loss under IFRS 9. First, identify the class of receivables. Receivables are categorized into different classes based on their risk characteristics. For example, we might categorize our receivables into 3 classes: low risk, medium risk, and high risk. Next, determine the probability of default for each class. The probability of default is the likelihood that a customer will not pay us back within 30 days past the due date. We can determine the probability of default by using historical data, industry benchmarks, or other relevant information. Next, we need to determine the loss given default for each class. Loss given default is the amount we expect to lose if a customer defaults on their loan. We can determine the loss given default by considering the amount of our exposure to the customer, any collateral we have obtained from the customer, and the expected recovery amount. Exposure is the amount of money we have lent to or invested in a customer. Collateral is any security we have obtained from the customer in the event of default. Recovery amount is the amount we expect to recover from a customer in the event of default, after taking into account all costs associated with the recovery process. Once we have determined the probability of default and the loss given default for each class of receivables, we can calculate the expected credit loss for each class. Expected credit loss is the product of the probability of default and the loss given default. Once we have calculated the expected credit loss for each class of receivables, we sum them up to get the total expected credit loss. For example, let's assume that we have the following information about our receivables. We have categorized our receivables into 3 classes: low risk, medium risk, and high risk. The probability of default for each class is as follows: low risk 1%, medium risk 5%, and high risk 20%. The loss given default for each class is as follows: low risk 10%, medium risk 30%, and high risk 50%. Using this information, we can calculate the expected credit loss for each class as follows. Low risk 1% times 10% equals 0.1%. Medium risk 5% times 30% equals 1.5%. And high risk 20% times 50% equals 10%. Summing these amounts up, we get a total expected credit loss of 11.6%. This means that we expect to lose 11.6% of the carrying amount of our receivables due to credit losses. Now that we know the total expected credit loss, we can recognize it in the income statement. The amount of expected credit loss recognized in the income statement is the difference between the total expected credit loss and any allowance for doubtful accounts that has already been recognized. For example, if we had an allowance for doubtful accounts of 5% of the carrying amount of our receivables, we would recognize an additional 6.6% of expected credit losses in the income statement. This is calculated as 11.6% minus 5% equals 6.6%. Journal entry for provision for expected credit loss. To record the provision for expected credit loss, we will debit the income statement for the amount of expected credit loss recognized in the income statement, and credit a liability account for the same amount. For example, if the amount of expected credit loss recognized in the income statement was 6.6% of the carrying amount of our receivables, the journal entry would be as follows: debit bad debt expense for the amount of 6.6 times the carrying amount of receivables, and credit allowance for doubtful accounts for the same amount. Let me show you another example. XYZ Company is a lender that provides loans to its customers. At the end of the reporting period, XYZ needs to assess its expected credit losses. XYZ uses a provision matrix to determine the amount of provision to be made. The provision matrix is based on the risk category of the customer. XYZ has categorized its customers into 4 risk categories: low, medium, high, and very high risk. The provision matrix requires that XYZ make a provision of 0.5% of the carrying amount of loans to low-risk customers, 1% for medium-risk customers, 2% for high-risk customers, and 5% for very high-risk customers. The company has the following information about its customers at the end of the reporting period. At the end of the reporting period, XYZ's customers are categorized as follows. Low-risk customers represent 60% of the total carrying amount of loans. Medium-risk customers represent 20% of the total carrying amount of loans. High-risk customers represent 10% of the total carrying amount of loans. Very high-risk customers represent 10% of the total carrying amount of loans. Required: determine the amount of expected credit loss that XYZ must recognize. First, we need to determine the amount of loans in each risk category. Loans to low-risk customers are 60% of the total loans, so they amount to 60% times total loans. Similarly, loans to medium-risk customers are 20% of total loans. Loans to high-risk customers are 10% of total loans, and loans to very high-risk customers are also 10% of total loans. Next, we need to determine the provision for each risk category. The provision for loans to low-risk customers is 0.5% of the carrying amount of loans to low-risk customers. Provision for loans to medium-risk customers is 1% of the carrying amount of loans to medium-risk customers. Provision for loans to high-risk customers is 2% of the carrying amount of loans to high-risk customers, and provision for loans to very high-risk customers is 5% of the carrying amount of loans to very high-risk customers. To determine the total provision, we multiply the carrying amount of each risk category by the corresponding provision rate, and then sum up the results. Therefore, total provision equals 60% times 0.5% plus 20% times 1% plus 10% times 2% plus 10% times 5% equals 1.3% of total loans. Therefore, the amount of expected credit loss that XYZ must recognize is 1.3% of total loans. In this case, we have assumed that the total carrying amount of loans is 100. Therefore, the total expected credit loss is 1.3. However, if the total carrying amount of loans is different, the total expected credit loss will also be different. I hope you found this video helpful. If you have any questions, feel free to comment down below. Please do not forget to like the video and hit the notification bell for future updates. Thank you for watching and see you in the next video.